Welcome to this special podcast, sponsored by Murphy Business Sales Edison, New Jersey office, where your business aspirations meet expert guidance. Whether you're looking to sell your business or explore new acquisition opportunities, we are here to support you every step of the way. Join us as our hosts deep dive into small business topics which are relevant for buyers, sellers, and other transaction advisors in the ecosystem.
Welcome to the Deep Dive. Today we're looking into something that's, really shifting gears right now, the world of buying and selling businesses. We're focusing particularly on the lower middle market, and whether you're maybe thinking about selling your own company or perhaps you're out there looking to acquire one, understanding these changes, it's not just helpful, it's pretty much crucial for your strategy. So we're going to really dig into this evolving buyer landscape in the lower middle market and the key M&A trends that are shaping things as we speak.
Exactly. And for this discussion, we're leaning on some really fresh data. We've got insights from an Axial article that just came out in May 2025, so very current stuff on buyer behavior. And we're pairing that with a broader lower middle market M&A trends report covering 2024 into 2025. Our goal here really is to pull out the most important nuggets for you. Who's actually doing the buying? What kinds of businesses are they after? How are these deals getting structured and closed? And maybe most importantly, how can business owners like you best prepare to navigate all this and, frankly, get the best possible outcome?
Okay, so let's unpack this changing landscape. You mentioned the lower middle market, or LMM. Traditionally, who are the main players there? Was it mostly like the big PE firms and corporations?
Yeah, that's pretty much spot on. For a long time, it was dominated by your established private equity groups and larger strategic corporate buyers. But what we're seeing now is, it's diversification, a big one. We're seeing this whole new wave entering the scene. Think independent sponsors, family offices, holding companies, search funds. Plus, there's this surge of, let's call it, more flexible, founder-friendly capital. It feels like the market's tilting, towards smaller, more agile acquirers.
Or nimble, maybe.
Exactly, nimble. And it's not just a fad. It seems to reflect this need for more hands-on operational involvement after the deal closes, especially for these smaller businesses aiming for real growth, not just a quick sale. These newer buyers, they often see value where traditional PE might not. They want that operational involvement. They're looking for longer-term partnerships, and they're, frankly, much more open to creative deal structures. That's quite different from how things used to be.
And the Axial data really backs this up, doesn't it? I saw a number that jumped out. Nearly 1,000 new buyers joined their platform just in the first few months of 2025.
Yeah, almost 1,000. It's a striking number.
And that's on top of already huge growth, right? Like 96% year-over-year growth in new buyers in 2023.
Astonishing, yeah. 96% in 23, and then another 38% growth in 2024. Hit an all-time high of almost 2,000 new buyers last year.
Wow. So that's a lot of new people looking for deals. Does that just make things hyper-competitive for buyers, or is the market big enough?
It definitely ramps up competition for the really attractive businesses, no doubt. But the lower middle market is vast. There are so many companies in that segment, so there's generally enough opportunity. But what it does mean for sellers is, you need to be smarter about who you engage with. You can't just blast it out there anymore.
Right. So with all these different buyers, what are they actually looking for? Is there a typical size or type of business they're targeting?
There is. If you look at the deal intent data, basically, what buyers say they're looking for, there's a really strong concentration. Get this. Over 90% of the deal intents across almost every buyer type fall within the $1 million to $3 million EBITDA range.
Okay, so EBITDA earnings before interest, taxes, depreciation, and amortization, that key profitability measure.
Precisely. So that $1 to $3 million profit range seems to be the real sweet spot in the LMM. It's where most buyers see that ideal mix of, manageable size but still decent growth potential.
But I bet it varies a bit depending on who is looking, right?
Oh, absolutely. The nuances are important.
Yeah.
Take private equity firms. Their interest is strongest a bit higher up in that $3 million to $10 million EBITDA range.
Which makes sense. They often need more scale for their funds.
Exactly. They're looking for more established, scalable platforms usually. But then look at individual investors.
Ah, yeah. Where do they focus?
Their demand is overwhelmingly in that $1 million to $3 million range. Over 96% of their interest is there. And they're even very active below $1 million EBITDA, over 92% interest there too.
So much smaller businesses, maybe more hands-on owner-operator type deals.
Often, yes. They might bring a more personal approach, maybe a longer hold period, but potentially less capital for big growth initiatives compared to, say, a PE firm is a trade-off for the seller.
Okay, and what about those other groups? Independent sponsors, family offices, holding companies?
They're interesting because they're quite active across a slightly broader range. Strong demand, pretty balanced, right across that $1 million to $10 million EBITDA spectrum. Somewhere between 80% and 95% of their interest falls there.
So they're flexible.
Seems like it. They seem to like those mid-sized businesses, big enough for growth, but still agile, and often very focused on being founder-friendly.
And search funds, where do they fit in? I hear a lot about them.
Search funds are laser-focused, almost 98%, 97.93% to be exact, of their deal. Intent is squarely in that $1 million to $3 million EBITDA range.
Wow, very specific.
Very. They're typically looking for stable, profitable businesses that are, let's say, operationally approachable for a first-time CEO, because often the searcher intends to step in and run the company themselves.
Okay, so understanding these preferences is, well, it's huge for sellers. You can really tailor your pitch.
Exactly. If you know who's most likely interested in your specific size and type of business, you can highlight the things they care about most. It makes the whole process smoother and hopefully leads to a better partnership after the deal.
Makes sense. So that's intent. But intent doesn't always equal action. Who's actually getting deals done? What does the closed deal data show us?
All right, let's look at the actual transactions from 2021 through May of 2025.
Yeah.
It definitely confirms that diversification we talked about. Independent sponsors, they've been consistently strong players, closing around 30% of the deals pretty steadily over that period.
Okay, a solid presence. Any major shifts?
Yes, a big one, family offices. So far in 2025, they've actually closed the largest share of deals, 30%.
30%. Wow. What were they before?
Just 16% in 2024. So that's a really significant jump.
What do you think is driving that?
It could be a few things. Maybe a strategic decision to get more direct control over assets, looking for that long-term appreciation you get from running a business well. We're also seeing search funds and individual investors gradually increasing their share of closed deals too, reinforcing that mix.
Okay, and what about the value of these deals? Are certain buyers consistently paying more? Let's talk TEV, total enterprise value.
Yeah, the TV data is interesting. Private equity, as you might expect, consistently plays at the higher end. Their average closed deal TV has been between roughly $13 million and $17 million over the last 4 years.
And in 2025 so far?
About $14.2 million on average for PE so far this year. It just confirms your focus on larger deals.
But you mentioned someone else standing out in 2025.
Yes, holding companies. Now, granted, it's partial year data, but so far in 2025, they have the highest average TEV at $31.4 million.
Whoa, double the PE average.
Pretty much. It really suggests they might be making a strategic push for larger platform acquisitions right now. Maybe building scale in certain sectors.
Interesting. And what about independent sponsors and family offices on the TEV front?
Their average TEV has been more variable. They had some sharp peaks in average deal size in 2020 and 2024, but it's dropped off a bit in 2025 so far.
Any idea why?
It could suggest maybe a temporary shift towards smaller, perhaps more opportunistic deals for them this year, or maybe they're focusing on businesses needing more operational heavy lifting rather than just big capital infusions. It's something to watch.
Okay, so that's the buyer side. Let's zoom out a bit. What were the broader market conditions like in 2024 leading into this year?
Well, 2024 generally continued a bit of a slowdown we'd seen starting earlier. M&A volume in the lower middle market was kind of flat, maybe slightly down.
Why was that?
A lot of buyer caution, really. You had ongoing worries about inflation, uncertainty around interest rates. It made people hesitant to pull the trigger on big deals.
And who was doing deals then?
Strategic acquirers, meaning other companies in the same or related industries, they led the way. They accounted for something like 56% to 70% of the deal volume. Makes sense, as they're often looking for synergies or market share gains.
Right. And I remember reading about this huge pile of money sitting on the sidelines. Private equity's dry powder, something like $1 trillion.
Yeah, a massive amount. Capital raised, but not yet deployed.
So what's the deal with that? Is it all about to flood into the market now?
Well, that dry powder, combined with some other factors, is definitely setting the stage for a potential rebound. We saw the Fed start cutting rates late last year. Inflation expectations have eased. That's creating a positive environment for deal making in 2025.
So even though valuations maybe dipped a bit in the last couple of years...
They did compress somewhat, yeah.
Yeah.
Middle market EBITDA multiples averaged around 9.1 times by late 2024. Down from closer to 9.9 times back in 2022. Things like reshoring, bringing manufacturing back onshore. A big focus on supply chain stability. plus automation adoption, and importantly, a lot of federal spending filtering through from infrastructure bills and tech initiatives.
And typical deal multiples there?
Usually somewhere in the 7 to 10 times EBITDA range. Buyers are often looking for specific niche capabilities or advanced tech.
Okay. What about consumer goods? That sector's been a bit volatile.
It's reviving. After the post-COVID surge and then a cool down, M&A volume jumped about 8.6% year over year in 2024. Valuations firmed up a bit too, around 9.6 times EBITDA on average as inflation pressures eased.
And who's buying there?
A lot of corporate buyers are actively hunting for niche brands, maybe direct-to-consumer models, or companies focused on sustainability, things that offer specific growth angles.
Gotcha. How about construction and infrastructure? You mentioned federal spending.
Yeah, that sector's seeing really strong growth. Deals surged, got this 65.6% year over year by the middle of 2024. It's largely fueled by just healthy project backlogs and all that federal infrastructure money finally hitting the ground. Multiples can vary quite a bit depending on the subsector, often mid-single digits, but the sheer volume of activity is making it attractive.
Okay, one more, B2B services. Always a big category.
Stable, but buyers are still a bit cautious there. The trend has been towards smaller deals. About 3/4 of the transactions in 2024 were under $50 million in value.
And valuations.
Median multiples are generally in the 6 to 10 times EBITDA range. Buyers are often looking for things like software-enabled services, predictable revenue, strong customer stickiness, maybe niche businesses spun out of larger companies. So if we sort of pull all this together, knowing these trends, knowing the buyer types, the big question becomes, how does a seller actually position themselves to capitalize on this? How do you maximize your value in this market?
Right, the million-dollar question or maybe multi-million-dollar question. And experts like Capstone really stress a few key things for owners planning an exit. First off, it sounds basic, but prepare way in advance.
Absolutely critical. This isn't something you start thinking about 6 months before you want to sell.
No, they say start planning years ahead. Really clarify your own goals first. What's your target price? What's your ideal timing? What role, if any, do you want post-sale? What kind of buyer feels like the right fit?
And get your house in order financially.
Exactly. Financial and operational cleanup. Have 5 to 7 years of complete financial statements ready. Audited is even better. Get updated forecasts together. Seriously consider getting a quality of earnings, or QOE, report done.
That QOE is huge for buyer confidence.
Yeah.
It verifies your real, sustainable earnings.
Totally. And operationally, streamline things. Improve those margins. Look at your working capital. How efficiently are you using cash? Clean books and smooth operations just make you instantly more appealing. Then there's the people and process side. Strengthen your management team. Have a real succession plan. Why? Because companies that depend entirely on the founder.
That are just less valuable, buyers get nervous about that dependency.
Right. Show you've built something that can thrive without you being there 24/7. And get organized. Pull together all that key info before you go to market. Corporate docs, tax records, key contracts, IP stuff, compliance.
Have it ready in a data room. It signals you're professional, well-managed, and it avoids painful delays later.
For sure. And crucially, assemble your A-team of advisors early. Don't try to do this alone.
Please don't. You need a good M&A advisor or investment banker who knows the market. You need an attorney who specializes in M&A, not just your regular corporate lawyer.
And a dedicated CPA or valuation expert, maybe an estate planner too.
Get the right experts in your corner. It pays for itself.
Okay, last big pillar. Optimizing for valuation and executing strategically. What does that involve?
It means highlighting the things buyers pay a premium for. We mentioned recurring revenue. Emphasize that. Show stable, predictable cash flows.
And deal with concentration risk. Right.
Oh, absolutely. If one customer is, say, more than 20 or 30% of your sales, that's a red flag for buyers.
Yeah.
It can seriously ding your valuation maybe by 40–50% in some cases. Diversify if you can.
What else boosts value?
Investing in growth drivers. Do you have unique technology? Are you strong on ESG factors? Showcase recent wins, new contracts, market momentum.
And then there's timing and flexibility.
Right. Keep an eye on market conditions. As we said, 2025 might be stronger for valuations. Try to time the start of your sale process near a peak in your company's performance. And be open-minded on deal structure.
Like earnouts or rollover equity.
Exactly. Earnouts, where part of the price depends on future results, can bridge valuation gaps. Rollover equity, where you keep a stake in the company alongside the buyer, shows your confidence and aligns interests. Flexibility can get deals done. And just to really hammer that home, that Capstone framework makes it so clear. The operational basics are what fundamentally drive value. Predictable revenue, tight costs, strong market position, a solid management team ready to take over.
These aren't just nice to haves.
Not at all. They're the absolute core drivers. They show a buyer not just a snapshot of today, but a clear, stable, and potentially very profitable future. That's what gets you the best valuation.
This has been incredibly insightful, a really good look at how dynamic things are in the lower middle market right now. We've covered the new types of buyers stepping in, the data showing what they want, how deals are getting done,
And hopefully some really practical advice for sellers on how to prepare. Which brings us to a final thought for you, our listener, to maybe chew on. Given all these trends we've talked about, this changing landscape and how crucial preparation is, how might focusing, maybe starting today, on just one or two of those key value drivers, whether it's strengthening your management team, cleaning up financials, or tackling customer concentration, how might that fundamentally change your own strategic path, whether you're thinking about buying or getting ready to sell someday?
Something to definitely reflect on. How can you apply this knowledge to your own situation and future plans? Thanks so much for joining us on the Deep Dive.
Thank you from all of us at Murphy Business Sales for taking the time to learn about this important topic. We look forward to working together to achieve your business aspirations. For more information or a complimentary consultation for sell-side services, visit us at murphybusiness.com/Edison and complete our Contact Us form.